Joining me today for Investment Insight is Asief Mohamed, who's Chief Investment Officer over at Aeon Asset Management. Thanks so much, Asief, for joining us this afternoon. Let's get straight into things. We've had 85% approval for that Greek debt swap deal, initially spurring things. Looking at the local picture on the local bourse this afternoon, though, it seems that some of that optimism is starting to wane once again.
Yes, and part of the reason why the optimism might be waning is that the hedge funds might be holding out for a better deal, and they're probably going to try and come in and try and squeeze a bit more out for themselves. I doubt that strategy will succeed because the Greek government and the Europeans have basically said, this is the money we've got on the table, we've got no more other money to give you. So the problem is if, and I think it's a small chance, if the hedge funds don't accept, you might have a very disorderly default, and that's really a concern because an orderly default is already priced into the market. A disorderly default, I don't think all the negative ramifications and all the unintended consequences is priced into the market, and you might have a knock-on effect into other markets and into other sectors. So I think the likelihood of if you might call it a disorderly default happening is low at this point in time, but one can't say for certain. What's also happening, although the debt restructuring, the formal debt restructuring has not been accepted as yet, it's not formally been done, indications are that it will be done. So it's already the formal, the debt restructuring is already trading in the market, and that debt already is trading at levels that indicates that that restructured debt is trading at default levels. So what it's saying is in a couple of months' time or a year or two's time, that debt is also going to default. It's trading at yields of about 20% at the moment.
So let's take a look at implications for the South African market specifically, because right now we've got the JSE on a historic and a forward PE of 12 and 11 times, and both this market along with the S&P over in the US are considered to be trading at fair value right now.
Yes, both markets in my view is trading at fair value. However, the one caveat that I do have is that commodity prices are close to highs, or trading out at high levels, and that has buoyed the resource profits and obviously reduced the PE on the South African market specifically. The US economy is very resilient. It's rebounded from its lows. So overall, I believe that our equity market and the US equity market is close to fair market value, fairly valued. It's not neither overly expensive or overly cheap. Yes, but I would have exposure to this market, and specifically where I would take exposure is an overweight resources position because of commodity prices holding up that well.
Let's look at what's keeping those prices up, though, Asief, because a lot of that hinging on the kind of easing and monetary policy easing that's come to the fore. And today we had inflation data out of China yet again influencing market sense that we're going to see monetary easing coming through yet again, which will be, of course, a good thing for Chinese assets, economic growth, and then commodity stocks as well.
Yes. I would agree with you on that. The inflation numbers coming below expectations will, make sure that the Chinese authorities ease monetary policy and support economic growth there. Economic growth will most likely slow down to 8%, and that's still very good if you compare to just under 3% for South Africa. And that should be good for commodity prices in the long term, and also good for South African resources shares that supply to China and to the global markets. However, the Chinese equity market has not been a good place to be for many years now because of the more competitive environment that those companies operate in. So I'd rather be exposed to resources companies externally based, external to China, that are supplying commodities to the Chinese economy.
Where are your stock picks sitting right now within the commodities complex on the local bourse?
I still have an overweight exposure to Kumba iron ore because of the exposure to iron ore, also an overweight exposure to Anglo American PLC, and generally in quality commodity counters. I'm overweight in those. More specifically, on the gold sector, although it's not been performing that well because of the gold price coming down and also the rand, recent strength of the rand, is Anglo-American, Anglo Gold Ashanti, where we've got an overweight position in it. But we've also got to look at the rand. The rand at the moment is what I would say is close to fair value at 7.50 rand. Fair value is probably 8 rand. It's not significantly cheap. One would take a position in the rand if it's more than one standard deviation, either cheap or expensive, because only then there's a chance of it correcting to close to fair value.
What's interesting, Asief, is that it's not just in the resources complex that you know, you've got an overweight position. You're starting to slowly build up within the construction space as well. So let's run through the strategy you're pursuing there and why exactly you're going down to that route right now, because there's intense debate as to whether now's the time or not.
Yeah. Construction has been a terrible performer, you know, since just before the World Cup, and you had the building boom in South Africa because the market anticipated the slowdown in the construction sector. They've had some terrible mistakes also, specifically in the case of Marion Roberts, where they've got 3 projects that's really been going bad. The Gautrain project, there's one project in Australia where they're losing lots of money, and another project in South Africa. So it's been bad news, but interestingly, if you look back in the long history of Marion Roberts, this is not the first time that they've had problems with trains. They had problems with trains many years ago, and the company nearly went bust. So this is the second time it's happening. However, they're having a rights issue now to show, it just indicates to you the dire position they are in. They're trading at 25 rand. The rights issue price is at 18 rand. I think it should, post rights issue, trade closer to the 18 rand level. We, however, from a construction perspective, think that things are going to improve, and things will eventually improve once the excess capacity has been taken out of the construction sector. It has not been taken out yet. This right issue doesn't help really in that sense, because it still keeps in excess capacity in the sector. However, once government spending infrastructure comes through, it will be another year or 2 years before it comes through, and that we know generally comes through very slowly, but they've indicated now that they're going to come through a lot faster. Once you see that coming through, we'll be increasing our weight. We have got exposure to the sector via WBHO, and we're looking to increase the weight in the sector as opportunities arise and prices hopefully come down, so we can increase our weight.
Let's go down into WBHO a little bit there and look at the investment case you see it putting on the table at this stage.
Yeah, WBHO has got a very good management track record, and it hasn't been spoilt by the record of let's say Marion Roberts management, especially the prior management and the management even before then. So, and the management at WBHO has illustrated that they can and they know how to manage these big construction projects. That's not to say that they're not going to make a mistake or become overconfident going forward. So from a valuation perspective also, the safer bet in the sector is WBHO. Avenge is also another company. We don't have exposure to it at this point in time. We prefer taking concentrated exposures, and WBHO is our route into the sector at this point in time.
For those who aren't as daring, and looking to go for the safer bets right now, let's look at something like MTN, because it's been standing on the radar screen as a strong dividend payer more so than anything else. Growth potential on the continent has stood out, but having said that, it's also come with its own set of risks with its exposure to the likes of Iran and Nigeria. Your position on a player like MTN out with impressive results earlier this week, Asief?
A very good set of results. I don't think Nigeria is a problem. Nigeria is probably an opportunity, a bigger opportunity for them. What could be a concern is the Iranian situation in terms of sanctions. And I must say the CEO gave a very good answer to a question when they asked him, when will they be forced to pull out of Iran? And he says when the South African government implements sanctions. So basically he's saying to the Americans, we're not going to listen to you guys. We're going to do it on the South African government's decision. I doubt the South African government would implement sanctions against Iran. at this point in time, but we can only wait and see in terms of what's happening. I don't think Iran, as such, its profits and its assets is priced into the MTN share price. So it's priced in, from these levels with a good dividend yield that they're paying, potential earnings growth going forward, growing African markets, I think MTN is a good position to be in and a good overweight position to hold for the longer term.
Certainly, where Iran remains a lucrative market for MTN, the network increased its market share in that country. We saw by 16.6%. Revenue grew by 26.5% in the country as well. But having said that, expenses also climbed 23.6%. Asief, let's leave it there. Thanks so much for your insights this afternoon.